In our previous video on the 7 investments that you need to have as a beginner in 2025, we did cover as follows. The first one was an emergency fund, which we said that one should sit in a money market fund account. With second one was a sinking fund, which was supposed also to sit in money market fund account. And we said the distinction between those two, an emergency fund is where we are going to be parking all our money. It will not only be an accumulation account where we are trying to build the fund that will be cushioning the other long-term investments against their untimely redemptions or liquidations before their maturity, which will be occasioning losses, but also it will be our parking point for every other amount of money that we want to transfer later on or accumulate to acquire the minimum investment amounts that are required to onboard onto the medium and long-term investment platforms. The sinking fund was an accumulation of resources or investing for a known goal or use that will fall in a period that will qualify to be in a short-term period. That is mostly in a period that is not more than one financial year or one investment year. Then the other important thing that we covered was investing in yourself. Yourself or the you investment is very important because as we shall be looking in the next video about on our net worth, we said you are the most important asset in this equation of investment. You are the creator of investments. You are the creator of the wealth that you are going to be relying on its cash flows in future. And therefore, because savings cannot grow yourself into wealth, but skills can make you wealthy. So we're saying investing in yourself is using your current resources into acquiring skills or skill sets that are going to give you multiple streams of income that expand your disposable incomes toward investing. Then the other platforms were what would cover those achievements or things that you want to do in the medium term or long term. And those ones we categorized that we shall be using our parking point, that is the emergency account, where we will now be transferring some part of that capital and locking it in higher return investments. Those are in bonds, where a bond can either be a government bond, those are the treasury bonds, or corporate company bonds. You will also have a special fund, which is a little bit risky compared to the money markets, and that risky element is what averages up the returns that you're expecting from that platform, because there is a direct correlation between risk and returns. So in order for our cumulative portfolio to average up, we need to spread or diversify our investments into low risk and higher or moderate risk investments, and we chose a special fund. And this is because we assume you are still enjoying the journey of investing and improving your learning curve towards investing in long risky investments such as stocks. Then the other one was holding a portfolio or a set of investments in equities. But we say that is an area that we are going to be trading carefully. We have to learn how stocks works, and we'll be looking at how best we can start investing in equities in our next video. Today we are looking at how we are going to match. These investments cannot just be conducted without a purpose. We need to have a known target or a known amount or with time that we require to accumulate, and also attach a purpose to that money, because that is what drives our commitment. That is what will drive our dedication and commitment towards achieving those objectives. Therefore, we are looking at matching the 7 investments or the 7 accounts to specific goals and purposes. After 3 seconds short break, before which you are going to give us a like to this video, continue engaging us in the comment section, and don't forget to share this information with another person, because those parameters are very important to the YouTube algorithm if this information is to be spread to other people. Welcome, and see you after 3 seconds short break. Welcome back, and thank you for your share, your like, and a comment. If you are new to the channel, or if you are seeing this video for the first time, I welcome you to our channel. And if you find value, don't fail to give us your subscription and hit the notification button, because this channel we are dedicating to give you at least 4 value-packed videos every other week, and YouTube will be sending you a notification once we upload the next video. What is a goal? A goal is a point. A goal is an amount that you are saving towards. It is an objective, the object which you want to achieve through your accumulation of your savings in an investment vehicle. Savings are packings of cash or money, but when those savings are put into an opportunity or an investment platform that cushions that saved amount against loss of value through inflation and grows the amount or that capital, the amount saved, by giving or piling a return that is more than the inflation rate compensation, then that is what we call an investment. When that investment is geared towards achieving a specific amount, the objective or the object, then that is what we call goal saving. And goal saving is very important, because goal saving keeps you objective and dedicated towards achieving that objective. And once you achieve your goal, you get motivated. There is a level of satisfaction that you get, which gives you synergy, which gives you energy to do another investment challenge to achieve a second goal. An object, if I use an example of what we do to pay your return, the rate of return will always be known to you in advance. For example, if you're investing in a money market fund that's paying you 16% annualized rate, then that rate of return, you already know it. The element that is not known is the amount that you are supposed to achieve, a specific amount of return. If you are targeting your investments after a long period of accumulations to be able to give you maybe 120,000 in a month, I'm assuming a person who could be paying a specific expense or a bill of 10,000 shillings every month, meaning this person would require a total of 120,000 in a year. If this person has a purpose of substituting that direct income that they have to work for to paying this rent with a passive generated income, so that they don't need to bother again working for that bill we are calling rent, then the object, which is the amount of capital that this person must accumulate over that time, so that when we apply the rate of return to the object, which is the amount that you have accumulated, will yield to the required return. That is the cash flow that you need to be meeting that particular bill. That amount of capital is your object. It is your goal that you will save towards. That is how you determine a goal. You first identify the goal, then you look at your abilities. Remember the account you that you said can be expanded in terms of generation of income, where if you are able to expand your skill set to generate more incomes, either actively, that is aggressively, or defensively by managing your expenses or budgets, then you shorten the period that you're supposed to take to achieve that object, the amount of capital that you require to generate a specific amount of passive return which serves a purpose. So that I'm trying to drive you to the next item that we are going to be looking at shortly. That is the purpose. So we have the investments, we identified the 7, then we have the goal, and there is purpose, so that we get goal-based investing or investing with a purpose. Because that way, that is the only way you are going to be able to beat the wealth creation game. Once you have been able to create your object, there are some parameters that are very important for you when you are designing your goals. And that is the time we say that a goal should be smart, so that you don't analyze to paralyze your investment journey. You need to make sure that your objectives, your goals are smart. That smart, those are initials for the specific attributes of a good goal that you are going to set come the new investing year. Your goal will be smart to mean S will stand for specific. That goal that you want to achieve should be specific and identifiable. Then the goal M will mean that that goal should be measurable. It's not only supposed to be specific and identifiable, but we should be able to measure it into monetary terms, because that measurability property of your goal is what will then give it the other attribute of being divisible. We are able to divide the ultimate amount that you require into smaller achievable amounts in shorter periods, weekly, monthly, or yearly, so that we are able to gauge that performance over the period of investing. The other attribute is A, which will stand for achievable. Don't set goals that are not within your means. Set goals that you are able to achieve within your means, so that once you achieve those goals, you get that much needed fulfillment to continue doing more. The moment you set unachievable goals, you evaluate yourself, you beat yourself down, and assume that you are incapable of achieving those goals, you are killing that dream of wealth creation. Then once you've done that, R will stand for realistic. Achievability will come through making your goals realistic. Then the last one, T, will stand for time element. Your goals should not remain unachieved forever. In order for the element of measurability for purposes of evaluation of your performance in your investment for goals, then these goals must be time bound. You are supposed to achieve those goals within a set period of time over which you'll be able to measure and determine, so that you consider whether you should put more effort or dedicate more of your incomes towards achieving the goal, or take the necessary actions if you are detouring from your investment journey. Those are SMART goals. Then once you have done your goal setting and you have started pumping or investing, accumulating in your investment vehicles to achieve those goals, these goals need to be assigned to specific purposes or specific uses. The use or the purpose for the goal that you have just achieved, that is now what gives us the portfolios. A portfolio is a collection of different assets that are supposed to generate a specific amount of cash flows that are geared towards a specific purpose. So the entire wealth, where wealth is accumulation of your assets, your total assets will form your wealth. That wealth is what we divide into 4 clusters, each cluster to serve a specific purpose. So we have 4 purposes or 4 portfolios, each serving a purpose. The first is a collection of assets or a portfolio that we will use to serve or to finance, to fund your lifestyle, your living expenses, and all that you need to survive or to live on as a person will be financed through cash flows that you are getting from your lifestyle portfolio. Then we will have another set of assets that are going to be dedicated to another purpose, and that one, the purpose that cushions these other portfolios, and that one we call a security portfolio. Security portfolio is what is designed to cater for events that, if not taken care of immediately, they are likely to put at risk or expose the other portfolios. And mostly security portfolio, we use it for purposes like education or management of diseases. The third portfolio will be your aspirational portfolio. If there are people that you need to take care of, relatives or people that you are not related to, that is charity or giving, you need assets. You need a collection, number of assets that generate cash flow that is dedicated for your aspirational purposes, for your charity purposes or giving. Then the last one is your legacy portfolio. That portfolio is equally important. But when now we get the 4 portfolios together, that becomes your runaway portfolio. Because in the event everything was to crumble, all those portfolio collapse into one, the runaway portfolio. And the runaway time is the total amount or the duration that it will take to survive on all your assets. That we'll be looking at the inner depth of the analysis of runaway portfolios when we'll be looking at the broader scope of emergency funds in a future video. Hopefully you have taken that for it home. We have the investments that we need to design. Those investments need to be targeting to achieve a specific goal or objective, and those objectives are meant for specific purposes. Remember, at last, the whole idea of wealth creation is replacing our active incomes with passive incomes that will relieve our time. Financial freedom is a freedom of time, that you are able to do things that you want, things that you like, without the fear of bills, the fear of financing. Thank you for watching.